Welcome to the SNB Experts Learning Platform. Today we tackle two of the most complex standards in the framework: share-based payment under IFRS 2 and insurance contracts under IFRS 17. Both involve complex measurements of future obligations. Prepare for a highly technical briefing. Our agenda is split. Part A covers IFRS 2, classification, fair value measurement, vesting conditions, and recognition mechanics. Part B dives into IFRS 17, focusing on the general measurement model and the premium allocation approach. Let's begin with Part A. Share-based payments are a critical compensation tool, and their accounting is heavily scrutinized. IFRS 2 is pervasive. It applies to all share-based payment transactions, whether with employees or third parties, and even if you cannot specifically identify the goods or services received. You must understand the grant date, when the terms are agreed, and the vesting date, when the counterparty becomes entitled to the instruments. There are three types: equity settled, cash settled, and choice of settlement. For equity settled awards, the golden rule is to measure fair value once at the grant date, with no subsequent remeasurement. We use models like Black-Scholes or binomial lattice to determine this value, factoring in volatility, risk-free rates, and expected life. Once that value is locked, it becomes your baseline for the vesting period. Now let's talk about vesting conditions. The distinction between market and non-market conditions is critical. If a non-market condition, like an EPS target, is not met, the expense is reversed. But if a market condition, like a share price target, is missed, no reversal. The risk was already priced in. Understand this distinction. You recognize the expense on a straight-line basis over the vesting period, adjusting your estimates for expected levers along the way. Our worked example shows a 3-year cliff vesting. Notice how the cumulative expense is adjusted each year based on the revised estimate of employees expected to vest. The period charge is just the cumulative expense minus what you've already recognized. It's a continuous true-up process. Cash-settled awards like share appreciation rights are different. Because you are paying cash, the liability must be remeasured to fair value at every reporting date. This creates significant profit and loss volatility. Let's look at the mechanics and what happens when you modify an award. With cash settled, many companies use total return swaps to hedge that volatility risk. If you modify an equity-settled award and increase its value, you recognize the incremental cost. If you decrease it, you ignore the reduction. After vesting, if options expire, the equity credit remains. Now, we transition to Part B, IFRS 17, the new era of insurance accounting. IFRS 17 replaces the legacy IFRS 4, which allowed wildly diverse accounting practices. The new standard enforces a current, market-consistent measurement of insurance liabilities. It is highly complex, but absolutely necessary for global comparability. Let's examine the three measurement models. The default is the General Measurement Model, or GMM. There's also the Premium Allocation Approach for short-duration contracts, and the Variable Fee Approach for participating contracts. The GMM is built on 4 blocks: the present value of future cash flows, a risk adjustment for non-financial risk, the contractual service margin, and insurance finance income or expenses. This is the foundation of the liability. The most critical innovation is building block 3, the contractual service margin, or CSM. The CSM represents the unearned profit of a group of contracts. IFRS 17 explicitly prevents you from recognizing profit on day one. Instead, you defer that profit in the CSM and release it over the coverage period as you provide the service. The cash flows must reflect current information and current discount rates. The CSM acts as a shock absorber. If estimates for future service change, they adjust the CSM, not current P&L, assuming the CSM isn't exhausted. The risk adjustment, Block 2, compensates the entity for bearing non-financial risk, like timing and severity uncertainty. As that risk expires, it's released to profit. Every block must be tracked precisely. For short-term contracts, typically 12 months or less, you can use the Premium Allocation Approach, or PAA. It's a practical simplification similar to traditional unearned premium accounting. But remember, the PAA only simplifies the liability for remaining coverage. The liability for incurred claims still requires full discounting and probability weighting. Under IFRS 17, insurance revenue is not equal to premiums received. Revenue is the consideration earned for providing coverage in the period. It's an earned service concept, much like IFRS 15. When comparing GMM to PAA, GMM defers profit explicitly through the CSM, while PAA defers it inherently through the premium deferral. Understand which model applies to your portfolio. What happens if a contract group is loss-making at inception? It's onerous. In this case, no CSM is established. The entire loss must be recognized immediately in profit or loss. You cannot defer bad news under IFRS 17. Underwriters must price carefully to avoid these day-one hits. Transparency cuts both ways. The disclosure requirements are extensive, demanding full CSM roll forwards and details on significant judgments like discount rates and risk adjustment methodologies. Both IFRS 2 and IFRS 17 deal with complex obligations and introduce deferred profit concepts. IFRS 2 fixes measurement at grant date, while IFRS 17 requires current measurement at every reporting date. Both require deep technical expertise. Let's summarize. For IFRS 2, distinguish carefully between equity and cash-settled awards, and never reverse expense for a missed market condition. For IFRS 17, remember the 4 building blocks: the role of the CSM in preventing day-one gains, and the revenue recognition principle. Let's review the common pitfalls to secure your understanding. A common error is remeasuring equity-settled awards after grant date. Don't do it. In IFRS 17, treating premium receipts as revenue is a critical mistake. Challenge yourself with these review questions. Contrast GMM and PAA eligibility. Explain the CSM's purpose. Determine the IFRS 2 treatment for different vesting conditions. If you can navigate these, you have mastered 2 of the most demanding standards in the framework. Proceed to final review. You have completed the Module 3 briefing. You now understand the mechanics of share-based compensation and the rigorous new architecture of insurance accounting. Maintain this level of precision. Dismissed. Thank you for your service to financial clarity. I'll see you in Module 4. Prepare for business combinations. Goodbye. For more professional financial modeling and investment analysis insights, subscribe to the SNB Experts YouTube channel. Thank you for following our Module 3 training. I invite you back for the next briefing. Until then, goodbye and stay focused on the architecture. Delivered on behalf of SNB Experts. Success is in the details. Final debriefing complete. Transitioning to next mission. Goodbye.